Welcome everyone. Welcome everyone. Welcome back to our bi-weekly free webinar. I'm your host, Dr. George Ozoude. We have our co-host as well, Dr. Adebayo Fasanya, who's in commute right now, so may come off mute and come off on camera in a second. But I'm going to get things started. I just wanted to introduce myself per usual. I'm the CEO of Time Health Capital, as well as Movement Orthopedic Institute, an orthopedic surgeon based in Houston, as well as a real asset syndicator. And I've been doing this real asset syndication for over 6 years now. Started my journey when I was a employed physician and I saw the writing on the wall of where medicine was headed. And I became very interested in obtaining passive income and financial freedom because I knew that would be the true way to having career autonomy as a physician. Since that time, I've gone on to invest as an LP in over 25 deals, ranging across multiple assets, including multifamily development, value add acquisitions, and then ventured out into other asset classes like mineral rights, farmland, agriculture, and medical office building. And started my own private practice 3 years ago, as well as started a syndication company to help other physicians get into the space. Since then, I've gone on to be a co-general partner in over four deals in over 800 doors with assets under management of about 75 million. And I'm real excited to continue this journey and bring other physicians and healthcare providers along. And so we do this bi-weekly webinar to not only educate, but to share opportunities and grow our community. We definitely know it's you can go fast alone, but you can go further together. So really excited to continue to grow this with Adebayo. If he can come off mic, that'll be great. But I'm really happy to announce we have a special guest moderator this evening who's going to be introducing our guests. We're going to be talking to us about select service hotel investment opportunities. So Charles is a friend of mine who I've met through Bio. He's also down in Houston. He's an engineer by trade, but he is a hungry and knowledge investor in multiple asset classes, including single family home rentals. And he's a budding star. He does a lot of underwriting, and I'm really happy to bring him on and call him a friend now. And Charles, if you can give us a higher level or deeper level overview of yourself and then introduce our special guest tonight.
Yes, sir. Yes, sir. Good afternoon, everyone. Thank you, George, for that introduction. My name is Charles Numnu. As George said, I'm based in Houston, Texas. I'm an engineer by trade. Worked in several industries, including oil and gas and in the tech space. Currently, I work as a program manager for Microsoft, building data centers, so very heavy on the infrastructure end. Also, like George said, I specialize in underwriting single family homes, multifamily apartments, and more recently, select service hotels. And today we'll be talking about investing in hotels and how you can become an owner of a hotel. And I have my business partners and friends, Tijani, also has a background in engineering, specializes in short-term rentals, and has a few boutique hotels. We've also got Sujay Mehta, has over 13 hotels that he owns and operates. Very strong background in both understanding, analyzing the real estate, but also operating the hotels, which are going to be very important as you guys will see today. With that being said, I'll turn it over to TJ and get it started off with this presentation.
Fantastic. Appreciate y'all so much. First of all, this is a true honor. I love doing stuff like this. Sujay and I get geeked out a little bit when it comes to presenting and talking about what we do in real estate investing. When I got into real estate investing, you can imagine I ended up putting myself through college. I went to University of Houston to get my engineering degree, as he mentioned. My background's in mechanical engineering. And one of my friends, he handed me a book and he was like, you need to read this book. I watch you hustle your way through college. You have to put yourself through school and you're a hustler. So I read this book. It was Rich Dad, Poor Dad, as y'all could probably imagine. And I took that book with me offshore and I was working on the rigs at the time. So I was an engineer working on the subsea installation vessels, working out in the rig, mainly based out in the Gulf of Mexico. And I took that book with me on a 3-week project and I read it twice in 3 weeks. And that was what kind of opened my mind up to real estate. But even as a new wholesaler, because that's a strategy I got into, and when I got into real estate as a wholesaler, if you were to tell me that I was one day going to be a hotel investor, I probably would tell you that there's no way possible, right? I think it's just something special about the real estate space. I get really jammed out. I really jam out, I should say, when it comes to doing deals creatively, for one, which is something that I love teaching or I love talking about, is learning how to do real estate deals without institutional financing and things like that. And so when I got into Airbnbs and started doing that, I got laid off from my job June 1st, 2017, and I launched my first Airbnb in December 2017. And so that low key became my claim to fame and of sorts, because I really went all in and I scaled that business, and that got me on multiple stages. And with me getting on multiple stages, I was able to connect with Sujay because a mutual friend of ours that is really huge on apartment investing connected us. And that is literally why we're here right now. And we combined our minds in what we do in the hotel space, me specializing in the boutique hotel space at the time we connected, and him specializing in the branded hotel space at the time we got together. And not only have we connected on the business tip, Sujay's became one of my close friends, close boys, and it's crazy. We connect on so many other levels, but that is my brother for life. And we feel like what we're doing right now, we're not only our real estate business, but really our community as well. So that's something that we take pride in, especially teaching people how to do this hotel business and showing what's possible in this hotel business. But nonetheless, my brother Sujay, again, I know Charles definitely introduced him, but I'll be remiss without saying that this is a guy, honestly, and I tell him all the time, bro, he's one of the smartest investors that I know, and honestly blessed to be able to call him brother and do business with him. So I'll let him introduce himself, and I'm going to turn it over to him here in a second, but I'm going to share my screen while he gets teed up. I'll tee up as well, and we'll be sharing the screen, and we'll go through a few slides. And as we go through the slides, feel free. We're actually not going to spend that much time on the slides, honestly, because we want this to be free flow. We want this to be conversation. We want to be able to make sure that we're adding enough value to y'all and answer all the questions that y'all have. Even as we're talking, whether we're going through the slides or not, feel free to interject with questions, right? Feel free to interject. If you want to type it in the chat box, feel free to. If you want to go ahead, if you want to interject and unmute, feel free to. We're cool with that. But nonetheless, we definitely want to make sure that y'all leave with a wealth of knowledge, especially when it comes to investing in hotels. So I know y'all are beasts at what y'all do in the doctor's office, and y'all are beasts at what y'all do, especially even as investors, because that's crazy. I'm hearing George speak about what he's got going on. I'm like, Lord have mercy. What am I doing in my life? Like, he's a whole doctor and also doing all he's doing in the syndication space and the multifamily space. But nonetheless, I'll turn it over to my brother Sujay, and I'll tee things up and we'll get going. Go ahead, brother.
Hey, what's up, everyone? Again, just grateful for the opportunity and the platform to meet all of you. As TJ said, we're going to do this family style. So feel free, if you have a burning question, you can't even wait to type it in. Feel free to unmute, chime in, disagree with us, agree with us, ask a question anytime. First of all, I want to give a shout out. I saw somebody drop Columbus in the chat. So I'm chiming in from Columbus, Ohio. I'm a Buckeye through and through. Last weekend hurt with that Oregon game, but we'll be all right. I'm a huge Ohio State fan. That's where I went to school, born and raised here in Columbus, Ohio. And ironically, I was a neuroscience major in college and pre-med. A lot of the Indian people we know, I know Goshal's here, Amit's here, most OHIO, there we go. So most of the Indian people we know are either doctors or hotel owners. And I was split between both. So I was neuroscience, pre-med. And then I actually went to India for a couple of years and did a program. Many of you guys probably heard of Jay Shetty, but did a similar 2-year program, life-oriented philosophy, and just took some time to figure out what my purpose was, what I wanted to do in my life. And similar to Dr. George, wanted to have freedom in my life. And obviously you guys all have gone through the tedious marathon of medicine and med school residency. My wife is actually an anesthesiologist. And so I tried to escape it, but somehow I still got trapped in it, and had to move around with her for residency, fellowship, and all that. But I decided that I wanted to do something more in the entrepreneurial world. So we opened up some addiction rehab facilities, Suboxone clinics, and Ohio just being, one of the capitals of that epidemic. We opened those up here, had a little bit of an exit. Family had done some stuff in real estate, some development deals, and just being around it, passively absorbing all the information, what to do, how to do it, and then really just understanding how profitable the venture was. I fully went into development. So my first hotel deal was in development, and then it just snowballed and it went into hotels, went into real estate. Now we do multifamily and all these other things as well. But hotels really was the niche, and we just went all the way. Now fellowship, residency, all that is done, and we're settled here in Ohio. So chiming in from Ohio, and just excited to meet everyone. TJ, hopefully you got the presentation teed up and we can get rolling.
So yeah, like I said, and trust me, like when I mentioned earlier that this is something that Sujay and I love to jam out on. We love what we do in real estate and teaching it, and we've held live events to where we've taught how to invest in commercial real estate, especially with assets like hotels. So go ahead, brother.
Yep, just overview. TJ, you can go past this to the first slides. Next, hit next on that too. Yep. Okay. So 59,000 plus hotels in the US. Like I alluded to earlier, ironically, about half of them are owned by people of Indian background. Clearly, it's not a monopoly. Anyone can invest into hotels. Anyone can own a hotel. Perfect. Let's bust some myths from the beginning. We're driving down the road. We're driving through the highway. We see on the right a Hampton Inn. We see on the left a Fairfield Inn, owned by Hilton, owned by Marriott, owned by Hyatt. These are the big brands. A lot of times we think McDonald's is owned by McDonald's, or the Hilton Garden Inns are owned by the Hiltons, right? But that's not necessarily the case. The way a lot of these franchised hotels are is it's a franchisee versus franchisor relationship. And what we do is we go out, we buy land, we build the hotel. The risk is ours, the upside is ours, the employees, the operation, the brick and mortar, the land, all of it is ours, right? And what we do is every single month we owe Hilton, Marriott, Hyatt, Choice, Best Western, whoever the franchise is, we would owe them 10, 15, 17% of our gross revenue. But truly the owners of the business are people like us. So you don't have to be Paris Hilton to own a hotel. You don't have to have prior ownership or prior hotel experience to own a hotel. And we're going to talk about the different ways that you can get into hotel ownership. So TJ, let's go to the next slide. So there's active and passive ownership in hotels. And so there's many different ways that you can invest into a hotel. The number one thing that we have to decide is, do we want to be an active owner or do we want to be a passive owner? And I'll allude a little bit why, that's so important when investing in hotels is because hotels, unlike other real estate classes, is a business. And with a business, there's a whole onslaught of problems that you may have to deal with from a day-to-day perspective. And so if you want to be an active investor, I would want to make sure that there's the bandwidth and you have the ability from a day-to-day perspective to handle those issues, right? So the different ways to invest into hotels. There's crowdfunding platforms, right? So a lot of the crowdfunding platforms that you guys probably have heard of is Fundrise or CrowdStreet, Reality Mogul. So a lot of these companies will put out a deal. They don't necessarily own the deal. They're not the sponsors on the deal, but it's a platform where someone can go out and post their deal and people like us can drop 50,000, 100,000, 250,000 into the deal. There's no negotiation. There may not be that personal relationship it's a crowdfunding platform. So there's a whole group of people that will be investing into the deal. Number two, REITs. So publicly traded companies that are large holding companies, you can buy stock into these REITs and you get some sort of dividends as they collect cash flow from their properties. Typically, the pros with REITs is it's typically a smaller dividend amount, but it's less risk and less reward, right? So they have many properties. They're diversified in different markets. If there's a downturn, yes, your dividends is going to go down, but they're pretty well diversified. But at the same token, if there's a 4 or 5 year stretch of just a great economy, you're not necessarily going to 2x, 3x your returns, right? And then number three is private investing. So that's a lot of what people like TJ, me, Charles, what we do is we go out and we build relationships with private investors, high net worth individuals, high income earners who are looking to invest with somebody who's an active investor in hotels. And so ironically, a lot of my investors are physicians. And so we'll go out and buy a hotel. A lot of our partners will be passive, limited partners. They have very little liability. They have no headaches. What we call mailbox money is what they're looking for. And so how hotels is a little bit different than multifamily or other asset classes that you guys may be a little bit more familiar with is it's not set income. So it's not every month we have a set lease like multifamily assets. It's a business. And so here in Ohio, for example, we have a lot of travel, a lot of events that happen in the spring, in the summer, in the fall. But then when winter comes along, it's typically a slower season for us. So we may do multiple profit distributions in the summer and less in the winter, right? That's how private investing works. We have limited partners, there's a sponsor, and then we'll keep going as hotel syndication. So private investing and hotel syndication are similar. It's a Venn diagram. Sometimes private investing can be a syndication, but a lot of times a syndication will be larger. So there will be a specific sponsor that goes out, syndicates a deal. Maybe it's a $50 million deal, and they'll go out and have an email blast and send out OMs where people can learn about the deal and then invest into the syndication. That will be strictly a GP LP structure, no liability. Whereas in private investing, maybe it's a group of 4 or 5 individuals that come together and we raise $3-4 million and lock down a $12-13 million deal. And in private investing, you become a true partner of the deal. Whereas in hotel syndication, it's less liability, right? Let's keep going. So just one of the things when we're looking at hotel investments is what is our investment criteria? So the first thing we want to do is figure out what kind of hotel that we're looking for. Number 2 is when do we plan on investing, right? So due diligence period is typically 90 days on a deal. So we want to make sure that we're properly capitalized, we have the bandwidth, we're ready to go out and invest into the deal. Where do you plan to invest? Again, it's a business, hands-on operation. So it's very important when looking at where do we want to invest. Why are you investing? Obviously, the why is fundamental in any venture that we do. And how are we going to invest? And so that kind of comes back to the active versus passive. So the different types of hotels that we deal with typically is limited service hotels, economy hotels, extended stay, resorts, full service, and luxury hotels. Again, some of these have similarities, but really I would say there's almost 3 different buckets. So one is the economy, one is the limited service, and then one is the luxury or full service hotel class. And so limited service, or we'll start with economy. So economy is your typical budget hotels. So your Red Roof Inns, your Motel 6s, your Super 8s, most of the hotels that we don't want to stay at, but there's a lot of cash flow, right? Very little maintenance, very little requirement from what the guest needs, from the amenities that are provided. And during COVID, ironically, these were the hotels that really just that crushed, right? It was a lot of the luxury hotels that struggled. The second bucket is limited service. Extended stay also falls into that limited service or select service hotel class. And so that's going to be your Hampton Inn, your Fairfield Inn, even your Holiday Inn Express. And then extended stay is your Candlewoods, your Home2 Suites, your Staybridge Suites. And so those extended stays are built for people that are staying for 5 or more nights. The pros to an extended stay hotel is because there's less turnover. Usually the profit margins are a little bit better, but obviously a little bit more expensive to build. And so usually the cost basis is a little bit more, but the flow through or the cash flow is better with extended stay. I'm going to stop here. If there's any questions, TJ, if there's anything you want to add, keep going.
Any questions so far on or anything we're talking about? I know we're just getting into it, but any questions so far?
While we're in this kind of definition stage, could you explain the difference between extended stay and then the limited service? Because even though they're in the same bucket.
Yeah, absolutely. So limited service will be hotels that are catered for 1, 2, maybe 3 night stays. And it could be, just typical king room and 2 queen room. And that typically what you would expect from a Hampton Inn, right? So you would have a continental breakfast. You have maybe 2, maybe 3 room types.
No
nothing
bar.
crazy.
Yeah, usually no bar, no like alcohol bar service and a limited service versus a full service.
Yeah, and
Kind of highlights it
and
too.
yeah, and with limited service, like you may still have a bar that you can drop into, but it's not a full service bar, right? With extended stay, very similar. So a Residence Inn is the typical example that I give for an extended stay. So very similar in terms of offering, but the rooms will be catered for a family or a worker who's going to be staying for 5 or more nights, maybe even a month or 2 months. A lot of in our Residence Inn, for example, a lot of the guests that we had business with was ALE, or people who have some sort of living issue, right? So their home burned down and now it's going to be 6 months for restoration. They need a place to stay. The insurance company will pay an extended stay hotel because our hotels have small kitchenettes in the rooms. They're more spacious, typically about 600 square feet, 550 square feet, versus the typical 250 or 300 square feet or 350 square feet. So a little bit more space, a little bit more room. They have small kitchenettes where some may have ovens or stoves. Some will just have a microwave, sink, and a dishwasher. It's not like living in an apartment, but it's the bare minimum to cater to that extended stay clientele. Does that answer the question?
Yes, absolutely. And I
Yeah,
think
perfect.
we can understand, a lot of medical providers can understand there's a lot of traveling medical work. So that
Yeah.
extended stay makes sense. Either you're
Yeah,
staying at an Airbnb or some kind of setup like an extended stay hotel. So it's nice
for
we
sure.
know that. It's kind of nice to understand now this new term, limited slash select service.
Yeah, no, it's a great point. A lot of, traveling physicians, traveling nurses will be coming into our properties and staying for a week at a time and coming monthly, right? It just allows them to stretch their feet a little bit more. When we're offering breakfast in a limited service, usually if somebody's coming for a day or a weekend or there's a sports team that's coming, they want a little bit more breakfast options. But if you're staying at a hotel for a month, you're not going to want those Sam's Club bagels every single day. And so you can get away with a more limited offering at an extended stay because chances are that those guests are going to go out and have their own meals or cook their meals inside their rooms. And so again, just going back to the profitability, because at the end of the day, that's what matters the most. Right. We don't
Yep.
necessarily have to buy an asset that we hope to stay in or live in. We have to buy an asset class that gives us the mailbox money so we can go travel with our family and stay wherever we want to stay. And with extended stay, because there's a 5-night stay or 7-night stay, your housekeeping cost goes down, your breakfast cost goes down, there's less check-in, check-out. And so because of all those reasons, the cash flow is a little bit better in extended stay hotels. And there's no restriction when we have an extended stay hotel. There's no restriction that we can't sell 1-night stays or 2-night stays, but it's just catered better for those 5+ night stays. And same thing with limited service. You might have someone stay for a month in your limited service hotel, but it just may not be as comfortable as an extended stay. So
Yeah, and extended stays have a way better chance of getting those big contracts too because of that extra feature, that the kitchen and all that.
yeah, absolutely. TJ, you want to touch on this?
Essentially, let's get to what makes a hotel successful. Three very crucial factors. Of course, location, and location matters. Of course, we know that in all real estate investing, but definitely more so with hotels. You'll find that, especially with branded hotels, those those extended stays tend to be more so in the outskirts, like in the burbs and things like that, where families are going to be located. A lot of times they're still situated in close to certain even medical centers that are still out there in the burbs, and you'll find those probably more so in the cities, or more so those 1 night, 2 night stays. You'll find a lot more full service hotels in the more populous areas and things like that. So, and
And
then
and the cool thing about this is, we always hear location when talking
yeah,
about real estate, right? But I'll tell you a story. So we have a Best Western in a town, Dr. Brown might know, Zanesville, Ohio. It's 60 miles east of Columbus, Ohio. It's literally in the middle of nowhere. Okay. It's not a huge town. It's not tiny either, but not a huge town. But that Best Western, like if and even the Best Western, it's not located in the main exit of the town, but it's located about 5 miles out of the town. And so if someone were to look at it from a bird's eye view, they would say this is a terrible location for a hotel. But it's right off of I-70. It's right pinched between Columbus, Cambridge. After Pickerington, it's one of the major exits. There's on I-70, there's a lot of travel. Yeah, see, Dr. Brown knows the town. So there's a lot of travel that goes from New York all the way to Chicago down I-70, a lot of truckers, a lot of fracking. And so that location is amazing for a hotel. So amazing that we invested about $1 million into that hotel. We cash flow about 80% a year on that hotel. And we're doing so well that we're actually building another hotel there. We're building a home two, which is an extended stay. So we have a limited service. We're building an extended stay hotel over there. Now, again, like I said, from a bird's eye view, someone would say this location is terrible. It's not prime time, Manhattan, New York. It's not, it's not in the mag mile of Chicago. It's not in Miami, Florida. It's not an A+ location, but location is a little bit subjective when thinking about hotels. So, right? You have to see who the clientele is, which brand are we selecting, which kind of takes me to my next point is every location has a brand that's associated with kind of that location or what might be best suited for that location. So when we're looking at brands, there's a couple tiers of brands. And so it goes with the economy, select service, luxury. When you're thinking luxury, Hilton, Marriott, IHG are the three big ones. Hyatt is also there when we're going and traveling. The Hyatts are amazing full service hotels. And so those kind of have a little bit of that brand name, right? Like you want to pop your collar when you're staying at one of those. The points matter and it has a loyalty base that follows it. A lot of well-off individuals I know are always Marriott loyalty members, right? So they're always staying at the Marriotts. And then
come from somebody like me, brother, who's came from like the Airbnb space, and I remember me and Sujay and I did a podcast, and I asked Sujay, I was like, so how do people that own branded hotels even view Airbnb? And is interesting because they view Airbnb as like almost like another brand, like another Hilton or another Marriott or things like that. But I'll tell you that there will always be something that hotels always have better, they'll always get it right over Airbnb, and that is the consistency factor. Because if I book an Airbnb, I can have a 10 out of 10 experience here, then I book another one, I have a 2 out of 10 experience there. If I book this Airbnb, I have another 5 experience and a 4. And so it's always inconsistent. But if I book a Hampton Inn here in Houston versus one in Phoenix, Arizona, it's literally the same product down to the bagels that they serve for breakfast. And so most people are rather a consistent 7 or 8 over time versus a 10 here, then a 2 here, then a 10 here. And so these brands, I realized that having a brand, especially when it comes to these branded hotels, go a long way. And this is why these brands charge the percentage that they charge and allow you to hang their flag.
Yeah. And so all of these brands TJ mentioned, like it's the consistency, right? So when you go to a Hilton, a Marriott, and IHG, you know exactly what to expect. You know the exact type of luxury to expect. When you go to a Choice, a Best Western, those are like the middle tier hotels, the Comfort Inns, the Best Westerns, middle tier. You're not going to have somebody that's bend over backwards, but you're going to have a clean, nice room that you can stay at. And then you have like your Wyndhams, your Red Roof, your Super 8s, all of those properties, which are more the economy. So every location, one location may be great for a luxury type hotel. One might be great for the economy mid-scale hotel. And so it's very important to understand that. I say these things because as investors, whether we're doing an active hotel investment or a passive hotel investment, I think that the two top things that we want to understand outside of operator, obviously, but the two top things outside of that we want to understand is what's the location and what is the business plan? And the business plan includes what brand are we buying or are we building or are we converting to, right? And so an example is Wilmington, Delaware. Wilmington, Delaware, when a lot of the work from home happened, it was like the financial hub of Delaware. And I remember seeing a crowdfunding platform that was trying to sell an office space conversion into a Holiday Inn in downtown Wilmington. And the location was good. The brand was good, but just with everything that's happening in the economy and work from home, I didn't feel like that location was going to be successful in the next 10 years. And so the operator might have been great. It would have maybe a good investment, a good basis. Oh, can everyone hear me? I just want to make sure.
Yeah, we got you.
All right, cool. Awesome. I saw that in the chat, so I just want to make sure. Anyway, that's the AI note taker. Funny. Man, it's taking over. So, but yeah, so going back, like location, brand, I think it's very important to understand that as investors, whether it's passive or active. It's definitely something, if somebody's pitching a deal, it's something that you definitely want to ask about and understand that and maybe do a little bit of research as are we investing in a $150 ADR, which is like our terms, the rate of the market. So are we investing in a high rated market or are we investing in maybe a $70 a night type of market? If we're investing in a $70 a night market, I don't want to build a full service Hilton hotel with all inclusive and XYZ, because
Full bar.
people are spending $70 a night in this market. We're gonna go belly up, right? We want to make sure that we're picking the right brand for the right location, and that's got to be one of the top questions that we ask when looking at an investment.
Sure, for
Question, do you look at saturation? That's obviously a big deal in so many other markets. Like
Yeah.
how many other hotels in that bucket are in the area, and what does that look like?
Yeah, no, great question. It's so funny because hotels are opposite when thinking about saturation, at least in the beginning. There's obviously a point where you become too saturated, but when I'm going to develop a hotel, I'm looking to develop a hotel on an exit that's already flourishing, that's already crushing it, because that means the demand is already there. That means that there's guests that are already staying on that exit, staying in that location. There's a need over there. When I build a brand new hotel, I'm quote unquote just stealing business from the other hotels. And so if I take 10% from 10 different hotels of market share, I'm going to be solid. I'm going to be the newest, the best in class hotel. I'm choosing my location strategically where it's well placed off the exit, has frontage off the road, it's not isolated. And so I want other hotels in my area when I'm building a hotel. If you think about a booming exit or a booming location or a location that you think is great, there's almost always for sure going to be a hotel that already exists there. So very seldomly am I going to build a hotel on an exit or in a market where it does not exist. Right. And so something else that we use something called a STAR report. So STR report. We use that pretty often when looking at feasibility for hotels. And that basically what it does is it pulls the entire comp set and it tells you what the occupancy is in that market. It tells you what the average daily rate or what people are paying on a daily basis per night in that market. And it gives you those two data points, which kind of gives us a good idea and reaffirms that we're making a good sound investment from a location perspective, as well as a brand and offering perspective to our clients. Now, obviously there is a point where, like in Houston, Texas, I think everyone just built and it got to a point where there's just too many new builds where the cost basis for a lot of these properties and in some of the isolated markets, it's so low because it's too overbuilt. There's just not enough business to support all the hotels. But in a typical market, when we're building hotels, I'm looking for a good basis of hotels in the market. The other thing is when we're doing an acquisition of a hotel and not building, you always have years of data to look at. So it's a business. So they should have 3 to 5 years of P&Ls that you can look at. You can look at the revenue and make sure that there's consistent revenue every single year. If you see a trend where it's going down, that's probably not the best investment, or we want to take that into consideration when making an offer for the price of the hotel.
Yeah, it should be trending up actually year over year.
Yep. And then the last thing is now it's a business, right? So when investing in a hotel, the number one thing to look at is who is the operator, right? Who is operating the hotel? Is it a third-party management company? Is it someone like Charles who's smart, efficient, knows how to underwrite, understands his numbers? And because with hotels, there's a lot of expense items. There's payroll, there's supplies, there's inventory, and you want to make sure that the operator or the person that is handling your business is smart, knows what they're doing, and has the right philosophy to run the hotel. And then the last thing, obviously, and I think this is the primary quality that's needed from an operator, and it's transparency. You want to make sure that there's transparency, there's values in the operator that you're investing with. Obviously, when you're investing in a crowdfunding platform, usually those big box operators have been vetted. They have $100+ million in assets under management. They'll be vetted by some sort of process, and we have to be able to trust that process. But if you're private investing and investing with an individual, you want to make sure that you know that individual, have references for that individual, have seen past projects that they've done, and they have some sort of track record. I think those are the three things when looking at a hotel. We can probably skip this, TJ.
Yeah.
We got a question. What's the typical exit strategy like or hold period?
Yeah, perfect. So typical exit strategy. So I'm gonna actually share my screen because I know we're
Go
tight
ahead.
time. So TJ, let me share my
Yeah.
screen. Not great with the sharing screen, but we'll try this. So here, this is just an example of a deal that we did recently. It's
Yeah.
the Courtyard in Grove City. We closed on this quite recently, just a couple months ago. And so just again, the outside, the exterior, it's 7, 8 years old. Interior has a little bistro, Starbucks, bar area. It's 104 rooms, built in 2017. It's a Marriott property, Courtyard. But really, I want to get to this page. And so for this specific investment, the equity requirement was 3.3 million. And this was done as a private investment. So a group of 7 of us came together and we took down this property. And so equity requirement 3.3 million. I put in 1 million, had folks come in with some additional capital. The average cash on cash return was 13%. We usually underwrite a 5 or 7 year sale. But when we're investing in hotels, remember, it's a business. So there's a lot of cash flow that comes from the hotels. There's depreciation that we can tap into, which we'll touch on a little bit later. And so it doesn't always make sense to exit in 5, 7 years. So oftentimes what we can do is we can refinance the property because we're paying down the debt. So we'll have a good amount of equity built up. So we can refi in 5 or 7 years, or we can exit. And typically we allow partners to exit after 5 or 7 years. And if they want to exit, we want to stay in the deal. We'll just buy them out for a fair market value at the time. And then the other partners who want to stay can continue owning. But typically a 5, 7 year exit plan is what we underwrite and what we're prepared for. I'll keep going a little bit further so we can see. These are the sources and uses of the funds. So we talked about $3.3 million investment. The debt comes down to roughly 10 million. So total $13 million deal. Now this deal is going to need about $1 million in renovation over the next 2 years. And then here's some uses, right? So there's franchise fees, there's loan fees, there's closing costs, and working capital needed. So total project cost is roughly 13 million. These are hotel metrics, debt assumption. We had a 6.1% interest rate on this deal. But going deeper, the cash on cash yield. So every single year, we're usually targeting 8 to 12% return, cash on cash, right? So if you invest $100, you should typically see $8 a year or $12 a year. It just depends on the market. Because interest rates are high, it's harder to get that 12, 15% return, and 8, 9, 10% is okay. And then when we refi, obviously the cash on cash will go up. So the cash on cash is about 12% on this deal in particular. And then at exit, obviously at a 5 year, there's a big, large capital event that happens where you're returned a good amount of equity, right? Over 5 years, that's where's the IRR and stuff. So that's where the IRR, equity multiple, all that comes into play. So
Are your management fees, is that for a third party? It's outsourced, or is that you guys are primarily
yeah, so
operating this on a day-to-day basis?
Yeah, great question. So we tried to partner with a large third-party management company to operate some of the hotels, because operations, honestly, nobody likes the operations. It's a pain in the butt. But one thing we learned is we're really good at it. And we had expectations. If we're going to pay someone $150,000 a year to operate our business, we expect them to operate better than us, if not as well as we do, right? What we found out is that a lot of these third-party management companies, and not all of them, right, but a lot of them, it's other people's money, right? And they operate as if it's OPM. Just hire an extra staff member. It's less headache. Just go ahead and purchase from here instead of purchasing from 2 or 3 different places where you can get better deals. And so by doing that, not only were we paying $150,000 to a third-party management company, but our NOI, or our flow through, was going down significantly. And so recently we made the switch of keeping the operations in-house. And so from now on, we actually take the management fees and we operate the hotel. Obviously, we invest into the hotel as well. It's not fully investor capital. We typically keep 20 to 35% of the deal. Some we own 50 to 75%. Some we own 20%, but typically 25 to 35% at minimum is what we like to keep in the deal as well. And we invest as LPs as well into that deal. Now, if we're working on a full service hotel and we don't feel confident in the ability to perform from a management perspective, we will have a management company and then asset manage that property on top of the management company. But good question.
Absolutely.
Do we have any other questions?
Maybe you could touch on the tax advantage part, just
Yes.
in particular, depreciation, how that works compared to like multifamily.
Yeah, when looking at a multifamily, so bonus depreciation, that's the term that gets thrown out a lot. Obviously, I'm not a CPA, but most of us have CPA partners or someone that we work with. Feel free to talk to them a little bit more about it. But bonus depreciation is a term that we throw out a lot. Now, bonus depreciation, the biggest benefit of bonus depreciation is parts of your property that don't have a lifespan of 27 or 30 years, like your land or your building, right? Like the foundation of the building. And so when we depreciate properties in multifamily, typically we see a 20 to 25% depreciation of the value of the property. But in hotels, we almost see 100% of our investment depreciated in most of our hotels. And that's because we have beds, we have TVs, we have window treatment or blinds, we have carpet, we have light bulbs, we have equipment, and all these things don't last 27 years. And so the typical depreciation schedule on a tax return is 27 and a half or 30 years on real estate. But for hotels, we can segregate about 30% or 35% of the hotel and accelerate that depreciation in year one. So to break that down into real numbers, recently we invested in a Hampton Inn. It was a $2.5 million investment. Our write-off for year one was a $2.7 million loss that we took. Now remember, it was a $2.7 million investment. The bank brought the rest of the money. Sorry, $2.5 million investment. The bank brought the rest of the money. So if I were to be a 10% partner, I would put in 2.5 million or 250,000, and my write-off would be 270,000 would be my loss. Does that make sense? So typically in hotels, the depreciation is much larger than what you would see in single family home, multifamily, self-storage, any other real estate asset class because of that furniture, fixture, equipment classification. So,
John, I see you have a question.
Yeah. Can you talk a little bit more on the franchisee and the franchisor relationship? Is there like a particular brand that you like working with more? And then how much business do they generate for you guys?
yeah, great question. The brands that I love dealing with, honestly, are a lot of the economy branded brands because the fees are less, right? For us, it's just bottom line, bottom dollar is what matters the most. But they're easier to work with, less red tape, less requirements. With Hilton, if we don't have a certain type of tea, we'll get penalized, a certain flavor of tea. With our Comfort Inn or our Days Inn, it doesn't matter if our toilet's working or not. It's fine. Just as a joke, obviously. But I typically like working with the mid-tier brands because they're more understanding. We're able to negotiate with them a little bit more. With that being said, I will continue to partner with Hilton and Marriott and Hyatt a lot, especially in the future, because they drive revenue. They have a loyalty base where, if I'm going to go travel and stay in, a Beaufort, Georgia, right? I'm not going to go stay at the Beaufort Inn. I'm not going to go stay at the Charles Inn, the TJ Inn. You're not either. You're typically going to stay at the Hilton, the Marriott, the Hyatt. If the price is the same, if the price is significantly more expensive than the Comfort Inn, I might stay at the Comfort Inn or the Comfort Suites if it's a nice, clean property. So these brands drive revenue, and that's the primary sales. When we look at boutique hotels or Airbnb does your sales, right? But when you're looking at boutique hotels, you have to have a brand. You have to have a website that's flawless. You have to create that clientele. But when you have these brands, they're doing, they're doing the social media, they're managing your website, they're giving points out, right? I mean, we have to pay for those points, but they give these loyalty points where, if I get 100,000 Hilton points, I don't care. I'll go stay at a Hilton. I'll go stay at a Marriott to get those Marriott points. So that way me and my family can redeem those points for a free vacation at the Ritz-Carlton when I'm traveling overseas, right? So those advantages of the loyalty basis with these brands is phenomenal. And a lot of our sales just happens through the brand. And so even when we're buying a hotel or we're building a hotel, we look to see how many, if we're doing a Hilton product, we look and see how many other Hilton products are there in the market, right? If there's a ton of Marriotts and a ton of Holiday Inns, I'm gonna go and build a Hilton product. If there's a ton of Hiltons and no Marriotts, or maybe just a small Marriott presence, I'll go build a Marriott product, right? A lot of the revenue comes from the brands. Does that answer the question?
No, that's great. Another question is, have you had any occasion where you had to switch from one brand to another, and how did customers respond to that?
Yeah, no, so we're working on a deal right now. It's a Sheraton in downtown Columbus, and we're looking to convert that into another Marriott product. And the reason that I'm doing that is because that brand, the Sheraton, the Four Point Sheraton, it doesn't have as much of a loyalty base, right? It doesn't have as good of a reputation as maybe a full service Marriott or a Town Place or a Fairfield Inn. And so we're looking to convert it into a brand that has a better name, we think it's going to drive better revenue. The customers, I don't think it matters as much, because remember, these customers aren't necessarily always return or repeat customers. I think the customers will come when they want to stay in downtown Columbus. They only have so many options. And when they see a recently renovated property or recently converted property, they're going to come stay with us. The other aspect of it is we have a Best Western that's not performing as well. And it's one that I just bought into a couple months ago, and we're managing it. I think it's a good property. I invested in it because it's a good opportunity. But I think if we were to convert it into, a Spark, which is a new Hilton brand, I think that it could generate a lot more revenue. And I think we would cash flow better. Typically I'm not really worried about what the guest is going to think. I'm more worried about, is it going to produce revenue, and is it going to help me push to the bottom line? The guests are, they'll book if they want to book. If not, we'll get new guests to book, by changing the brand, right? So good question though. I see a question on 1031 exchange. There is 1031 exchange for hotels. I actually did a 1031 exchange on this Courtyard deal that I showed a little bit earlier. We did a 1031 exchange. We sold a Residence Inn by Marriott in Northeast Ohio. We pulled out some capital, had to add a little bit more money, and we 1031. What happens with depreciation recapture is the same thing that would happen with multifamily. So once you start rolling that 1031 money, you're going to want to keep rolling it, because the moment you stop, you're going to get hit with that recapture bill, and the tax event will happen. I think, again, it has the benefit, hotels have the benefit of real estate as well as business. And I say business because it's the cash flow, right? We're not trading at 4% cap rates. We're not trading at 5% cap rates. We're trading at 10, 11, 12% cap rates. So
I got a question in terms of occupancy, right? With luxury senior living that we've done in the past, the break-even occupancy is around 40%. So you don't really need, it's not like 70% like multifamily. I'm just about the hotel, like what are you looking? I look at the one that you're buying, said 67%. Is that good? Is that bad? What's the
So the way we judge occupancy is we balance the rate and the occupancy both, right? If you looked at, the rate was pretty high in that market. And so we're okay if somebody's going to give us, I'd rather sell one room for $1,000 than 10 rooms for $100, right? Because if I have 10 rooms for $100, my wear and tear goes up, my breakfast cost goes up, my housekeeping cost goes up, my supply cost goes up, my laundry expenses go up, right? So I typically try to balance a lower occupancy and a higher ADR to produce the same amount of revenue versus having a high occupancy and a low average daily rate to have the same amount of revenue. Now, I say the same amount of revenue because that's key, right? I'm not going to sell my rooms for $1,000 a night and have nobody stay at my hotel, because that would be stupid. I think there's a balance, but typically when we're investing in hotels or we're operating hotels, we're typically plus minus 72 to 75%. So in terms of occupancy, that's a sweet spot. 75% plus minus a few percentage points is where we want to be.
Yeah, you're averaging around 90s, then it's most likely that your prices are too low. It's probably best to increase them.
Yep. Now there's situations where that happens. I have that property in Zanesville. We have a fracking crew that stays with us and they book out the hotel all year. I just don't have enough rooms. And I'd rather give them a discounted rate and then book every single room every single night and let me just crank, rather than try to raise the rate and price them out. And now I'm dealing with 60% occupancy and maybe $5 more on my rate, right?
Your process for determining the ADR?
Yeah, I mentioned something called a STAR report, so STR.
Okay.
So when we're going to buy the property, if it's an acquisition, you'll know the ADR based on previous financials, right? So they'll give you a trailing 12, they'll give you 2023 P&L, 2022 P&L, and you'll be able to see what the occupancy is, what the ADR daily rate is for, and daily rate, average daily rate, I throw that out because it's such a common term for me. It's part of my dictionary, but it's essentially like your rent roll, right? So what is your rent? What are the rents, market rents, right? That STAR report will also tell us what the ADR, average daily rate, for the entire comp is, right? So for the 5-7 hotels that are around me, what are they charging and how much are they charging? So that way I know when I'm creating my business plan, am I able to raise the rates or am I leading the market in terms of rates, right? If I'm leading the market in rates, then there might not be much room to drive rates higher.
Gotcha. Yeah, and I think my question was more with the caveat of Ifanyi's next question is this dynamic pricing. Does it adjust? Like with Airbnbs, TJ can probably attest. There's surges, there's peak seasons, low seasons. Does it adjust? And if there's a process that you use to adjust with it?
Yeah. So we do use dynamic pricing. And the great thing about the brands is they provide us a lot of software, tech, resources to manage those rates. What we do at a lot of our hotels is we have pricing that we do. We have somebody from the brand that we pay a service fee for, and they're monitoring the rates every day. But we're also setting parameters. So when we start booking at 60%, boom, the rate jumps up 10%. When we start booking at 75%, the rate jumps up another 15%. And so that's just to protect us. If the Super Bowl is announced I think it was announced in Atlanta just recently, but if it's announced for Atlanta in 2028, I don't want 100 people to call my hotel and book all the rooms while we're priced so low. So as people start booking, boom, the software will kick that in. But also that's where the operator is so important, and making sure that my general manager, she's checking the rates 2 times a day. Every single general manager at every single hotel is checking the rates 2 times a day. I can show you, I just got a text message from my general manager, like while we were on this call, and she's telling me what the occupancy is for the night, what the rate is for the night, and what's going on. And she sends me this like form every single day that tells me what's going on, and she's adjusting the rate. Very hands-on. You want to, and all our general managers are trained to do that. So there's dynamic pricing, both from an automated standpoint from like software, but also we're manually watching that daily. So if other hotels are increasing the rate, we're wondering why, what's going on? What do they know that we don't know? Right. So
even in the STR world, that's how we like to say it too. We say we like to price the way the hotels do, which is dynamically. That's literally how we put it in the STR world.
Good questions. These are awesome. I wish we had 2-3 hours to just talk about all things hotels.
Yeah.
I took a little bit too much time with the definition just because I wanted to make sure everyone's comfortable and understands the asset class.
No, super important. But yeah, we are at the 7:06 mark here. We want to definitely invite anyone to come off mute at this time if they have any more burning questions. You can also drop it in the chat. We do try to stay respectful of everybody's time. I know I even have more questions. I'm sure you guys do too. But if we don't have enough time here, Sujay, TJ, is there any way folks can get in contact with you? Where can we reach you? Where can we find you?
Yeah, absolutely.
You guys can type it in the chat also.
Yeah,
you can project it.
for sure.
And then,
I mean, what we doing? Should we do Cell phone numbers, Instagram. Which
Don't put it here because it's going to be on YouTube.
Maybe it'll go into the cloud.
Or when we send the
Email address
email,
yeah,
is
let's not
fine.
do that.
yeah, send it to us. When you send the email, if you want your cell phone,
Yeah.
and put it in the
And
email.
I'm putting.
And are you guys-
I'll drop my social, my email
I'm
as
putting,
well, both in there. Feel free to reach out. I don't mind, sharing my cell phone number individually. Reach out if you want to hop on an individual call. I'm happy to do that, and we can set up some time to hop on a call and just chat, get to know each other. And one of the very important things about this asset class is it's a business, right? So it's important to understand who you're partnering with, build that relationship, because there's cycles. There's ups and there's downs. And when COVID happened, I was telling these wonderful gentlemen earlier that when COVID happened, we thought we were going to lose our shirts. For a month, 2 months of shutdown, we were scared. But then PPP, all these EIDL, all these government things came in. We were fine. Didn't have to draw on any line of capital. Yeah, capital lines, no capital calls. And then 2021 and 2022 were amazing years, like absolutely amazing. We crushed. Our breakfasts were closed. No hotels were offering breakfast. So we saved $70,000, $80,000 right there. Everyone was tired of staying in their homes and wanted to go out and stay and travel and eat out and support local. And we crushed in 2021, 2022. And I told them I'll take a 2020 10 times if there's a promise that we're gonna have a 2021, 2022 afterwards. And so I think it's important to understand that there's cycles, there's ups and there's downs. And when you have partnerships, I think it's a great thing. And especially if you have a relationship. So happy to hop on a call, happy to talk about it. TJ, Charles, and I are happy. If you have another opportunity you want to invest in, we're happy to tap in and help just offer our thoughts or questions that we would ask and support you in your endeavors, right? So I think we're here for all of it. So part of the community.
You have a
Awesome.
website? Do you have a website?
Yeah, website.
So Bloom.ventures?
Yep.
Okay.
That's it.
Okay, so they can find you, find the calendar, and also you guys can reach out to us. So we'll link you guys up.
Oh, sorry. I think I put that in the direct chat. So I'll send it to all.
Yeah, I had actually put all of our information to the wrong chat too. I had to redo it.
There we go.
There you go.
All right. We're at the 10-minute mark. I want to thank you guys again. Definitely appreciate you coming on and educating our community. Charles, thanks for coming in and moderating the panel and the intros. Bio, I know you didn't get a chance to intro, but any last words or the chat was great.
Yeah.
This was one of our record turnouts, and I know you guys are working on some deals right now, so definitely we'll be reaching out and understanding, learning more about your deals. So thank you guys again. Any parting words, Charles, Bio?
Yeah, just want to say thank you, everyone. It's a very great panel. Because we have a lot of questions and things like that, we can come up with a different angle in the future also. And you guys don't mind coming back. It's a different asset class. And it's funny how you could have 10 years experience in real estate, but never touch hotel. It's a lot of similarity, obviously, but you still have to learn specifics of each deals. And there's a reason why there's many Indians. I know you say it's not a monopoly, but the truth is, if it's that easy to run, if it's that easy, then other people they'll be even more distributed. There will be some slight advantage or some things passed on and some tricks that makes it successful. And there will be the reason why someone might buy it and they basically fall on their face. Definitely believe that. So thank you for coming.
No, absolutely. Thank you all for the opportunity. Thank you all for your time. We appreciate it and happy to hop on anytime. And we may hop on just to learn from you guys as well. So
no, for real though. This has been amazing. This has been amazing. Thank y'all so much, truly.
Awesome. Thanks, TJ. Thanks, Sujay, for the time. Also, George and Bio and everyone that joined. Thank you guys for the opportunity. And the only thing I would stress is if there are any questions, please do not hesitate to reach out to Sujay, TJ, or myself. These are great guys, obviously very knowledgeable, and we're all currently working on some deals. So if you guys are interested, just reach out.
Yeah.
All right, guys. We will see you guys in 2 weeks. Thank you all. We want to wish everyone a good night, and we'll see you in 2 weeks for our next webinar. Have a great night, everyone.
Great night.